Welcome everybody to another episode of Equity Talks. I am pleased to be joined by a good friend of mine, Harsh Pandya. Harsh, how are you?
I'm pretty well. Thank you so much, Andrew.
Good. Harsh is an expert. He's a financial advisor and an expert in the way of investing money. He's the guy you want to talk to. Not only is he extremely well dressed, as you can tell by the suit, but he's extremely knowledgeable. So, Harsh, I always like to give the guests an opportunity to introduce themselves. So, I'll let you take the floor.
Thank you so much, Andrew. Thank you, TJ, for having me over. My name is Harsh Pandya. I work with a company which has been there for over 100 years. We have $2.2 trillion in assets, which makes us one of the world's biggest asset manager. I deal in everything you can think of when it comes to investments and insurance.
Excellent. That was a good introduction. I really like that. So
Thank you.
let's kind of just get into it, Harsh. So really what we want to talk about to begin with, I think, is, and we're going to just boil this down for everybody so that we're not going to flood them with technical jargon. We want to keep this as listener friendly as possible. So let's just kind of talk about empowering our listeners with financial literacy and decision making tools. So somebody calls you, says, Harsh, either they're a young person, like a teenager who's looking to get into starting to put some money away in proper investments, or they're new to Canada, or they're an established investor. They have a wealth of savings and they're looking to put money away. If somebody calls you, why don't you kind of just explore for the listeners what the process is?
Sure. So if you are a beginner, like Andrew mentioned, if you have got millions of dollars in savings, beat anyone, it is so important to start investing as early as possible. This is not just for your legacy. Obviously, it's for your legacy, but it's also for you to retire peacefully. It's important to have a financial plan in place, and you can begin by investing into as simple as GIC or savings accounts. Or if you are comfortable, we can go to stocks, and there's so many different avenues.
Excellent. So
Does that answer your
yeah,
question?
it does, and we're going to explore that a little bit more. So somebody wants to start putting some money away, or they already have money put away, maybe they want a different investment vehicle or another choice of financial advisor. You call Harsh. He's the guy you want to talk to, which is why it's so important we had him on today, because he has a wealth of knowledge and the experience to make your money work for you. And that's, I talk to friends of mine, and myself included, when we're sleeping, our money's making us money. And that's what's so important. So I want to keep this as layman's as possible, because it's so easy, especially, it's similar to mortgages, but in the financial world, to start throwing around these terms and people kind of get lost in the sauce and say, wait, what did he even say? So let's break it down. Stocks, mutual funds, ETFs, just give me a very elementary breakdown of each.
Okay. So I'm going to take one company's example to explain all three different investment options. Stock is basically you buying Apple from the Apple company. That's a stock. Mutual fund, when you buy mutual fund, you're buying a portfolio of stocks under one mutual fund. It can be 50 different companies, it can be 100 different companies. And ETF stands for exchange traded fund, which is similar to mutual fund, but it invests passively. So that is passively invested. Mutual fund is actively invested. Can I elaborate on that?
I'm waiting. I was
Okay,
waiting for the
wonderful.
elaboration.
Thank you, Andrew. So mutual fund is actively invested. What does that mean? Now, there's an active portfolio manager who is behind the scenes, who's buying and selling stocks for you. And ETF, it's passively managed, meaning there's a code in the computer which mimics a particular index or a particular fund. And that is why you see there's something called as MER on a mutual fund, which stands for management expense ratio, which can be 2%, which can be 2.3, 2.5, 1.5. It varies. So that's high on a mutual fund. ETF, it's as low as 0.05, and that's because it's passively managed.
Understood. Okay. So a lot. I know it's hard to explain everything in a very
Non-technical
rudimentary,
way.
non-technical way, because it is technical, which is why somebody would want to speak to you. Because if you're going to take it on yourself, and I know some people have done well, but I would say you're similar to mortgages. Like you're always going to want to speak to an expert because there's so many different avenues, and for one problem or one opportunity, there's 10 different answers.
Right.
And I think it's very similar in mortgages as it is in investing and in finances, where you want to find the person's risk tolerance and create a financial plan for them so that you're hitting their goals while you're making their money hit the goals that we've set out as well. So I like that a lot. I think that's as basic of an explanation as you could give. So I'm going to give you kind of a hypothetical. So let's say you have a beginner, whether that's in mid 20s, early 20s, but somebody who's not well versed in it. There's a beginner, they have some money, not a lot, and they call you and they say, Harsh, I want to start building a safety net or a retirement fund or some money. I want my money to work for me. What would you, let's play that out. Somebody calls you, says, Harsh, I've never invested before. What do you do with my money?
Absolutely, Andrew. So it really depends on what's that person's risk tolerance, as you mentioned, is going to be. What's that person's risk appetite? What's his time horizon going to be? And how comfortable is he with risk? How much of investment is he aware of? How much of mutual funds does he know? And how much does he know about stocks? So if he's someone who's a risk taker and he wants to buy Google, Apple, Tesla, Nvidia, I can do that. There is something called as dollar cost averaging, meaning he doesn't want to start with lump sum of 10, 20, 50,000, 100,000. He wants to contribute something each month.
Right.
So that is the one way. The other way is we start buying mutual funds for that particular person. Now, if that person is coming to me with $10,000, and if he says, I do not have a lot of money, but I commit you to investing $500 each month, I don't know what's good for me, you recommend me what would be the best for me. So after doing a thorough diagnosis of a situation, I would invest for him into a mutual fund because that gives him an access to 50 to 100 different companies as opposed to just one or two companies.
That's a good answer. So really, that's a good avenue for, let's call them a beginner, is a mutual fund.
That's right.
Okay, all right. And I want to kind of stick on that note. We'll go kind of through the phases of the life phases and the experience phases of people. So let's keep on young people, because I think it's pretty important. What would you say is the benefit of saving early?
The benefit of saving early. Wow. Okay, that's a great question. So, saving early, I mean, I remember my parents used to tell me, like, save every dollar, every penny you can, right? And my background is I'm from India, and my parents are very frugal. And I think that's how Indian parents are, right? They want you to be frugal so that you value money, so that you save, and so that when you're old, you are not dependent on CPP or OAS,
Correct.
which is peanuts anyway, right? So saving early, how does that help you? Is it takes 10 years for your money to double. I have seen my clients coming to me with $500,000. Their money is now $1 million, $1.2 million, and that's what it does for you. It grows your money exponentially in a way that the money takes care of you, since you have been taking care of your money since a very early age. So you take care of money, money will take care of you when you need it.
That's good. That's good. And it's like anything. It's like the snowball effect. As you start, the earlier you start, the better you are off later on.
That's
and
right.
I totally agree with that. And I can't tell you how many clients, because in the mortgage side of things, when we're submitting a deal to a bank or to a B lender or even private, we look at people's finances, and I can't tell you how many people haven't saved. And later in life, they're like, I'm stuck. And they're, what's the saying that we use in this industry? They're house rich, cash poor. And I think finding that balance and saving early is really imperative. So I love what you said there. And for everybody who's listening, you want to speak with somebody like Harsh as soon as possible. Really, if you haven't done it already, call them, and we'll put your link in the bio and everything. And if you are just getting into it, speak with somebody like him, because the earlier you start saving, the better you are off later on, and the more money you're going to have. So that's huge. And let's just go again on this subject. So you touched on it a bit, but teenagers, young people, we think the best way is mutual funds, or one of the best ways.
I mean, it again depends on a person's situation, right? And I would like to touch on mortgages, just like you are
Please,
an
please.
expert on mortgages,
That's our area of expertise.
right? Andrew is an expert on mortgage. So I used to do mortgages. I worked in two banks in my past life, top five banks, and I used to do mortgages for my clients. And I've seen many clients who got equity line of credit, and they have got two trucks. They've got a big
I
house,
see that all the time. Car payment, mortgage payment,
no
lines of
savings.
credit, credit cards, no
Exactly.
savings.
No
Yeah, we
savings.
see that all the time.
So, coming back to your question, the perfect avenue for a person depends on the person's situation. Where is he coming from? Where is that person right now? What is he saving for, right? Is it for kids' education? Is it for buying a house? Is he saving for retirement? Now, talking about a young person, they're pretty much saving to buy a house. And I've spoken to a lot of young clients, right? I've got a lot of young clients under my book, and they are 7 out of 10 times saving for a house. So there is a wonderful account opened by the government for the people. It's called FHA. It stands for First Home Savings Account. Started in 2022. An annual limit for that particular account is $8,000. But if you haven't opened it yet, if you open it today, which is December 28th, you get 8,000 limit for this year. If you open it next year, you miss out on the contribution room
Right.
for the previous years. So the sooner you open, the better it is. If you're someone who is saving for retirement, I would suggest we put into stocks paying dividends. I've got clients with $1 million portfolio. They are making $40,000 to $60,000 just from the dividends. They are not touching their principal, just living off the dividend income, which is huge. There are a lot of companies out there paying dividends on a regular basis, and no matter what, if we are hit by COVID, if there's another interest rate dip, companies won't stop paying dividends, right? Because those are the boring companies which we pay electricity bills, which we pay phone bills every month, no matter what. However short of money we are running from, right? We have to pay those bills. So those companies pay you a dividend, which is going to be every month. So you can invest in stocks. If you're someone who just want to park their money, just like for someone who's closed a house, right? And they've got like 500,000 sitting in a bank doing nothing. Park it in a savings account. I have got 10 different savings accounts which pays 3 to 4%. I have got a savings account which pays interest every day. So you park it there for, let's say, 60 days, and your money won't go down at all because it's not invested in the market, and you'll get out with interest amount on your principal. You can park it in GICs. You can buy bonds if you are a retired person. If you're a senior person, you can, because bonds are something which pays you interest every 6 months. So there are a lot of different avenues, a lot of different
So
situations.
for everybody that heard, because he went through 15 scenarios, pick up the phone and call Harsh, because there is not a one size fits all answer. You need somebody like you that can say, like a doctor, this is the diagnosis, this is the solution, the
prognosis, yeah.
prognosis. Thank you. Yeah, exactly. So that is that's awesome. And you're obviously very well versed, which is why we wanted to have you here. One thing we get a lot of, and I love it because grandson of immigrants, and we're seeing a lot of new to Canada, and a lot of business is new to Canada. So let's just touch on that a little bit. We're going to go from now early investors, teenagers, young people, let's call it, and more. I mean, there is still new to Canada people coming here that are young, but I see the vast majority in the older section or middle age. So somebody's new to Canada here. What are the challenges? What are the recommendations? What would you say to somebody who's calling you who's new to Canada?
So if someone who's just come to Canada, I am an immigrant. I came to Canada 7 years back. So I had no financial knowledge whatsoever. I'm a science student. I graduated in geology. So I started taking a lot of interest when I came to Canada. I finished my certifications because I have to study, I have to have licenses for selling stocks, for selling mutual funds, for selling insurance, ETFs, all of that. Right. So for someone who's just who's very new to Canada and who's looking to start saving and investing, they can open up a TFSA, they can open up an RRSP, they can open up an FHSA. If they have kids, they can open up an RESP. Right now again, if that really depends on what's the status, right? Are they coming here on a permanent
For
residency?
sure, that definitely, yeah, it, definitely makes a difference for sure. Yeah.
Right.
Yeah. What, and I'm sure you get a lot of your book is people who are new to Canada, or at least some of your book. What are the kind of the common challenges that you see?
So common challenges right off the bat, I think they are not very familiar with the different account types, right? They do not know where to start with. They do not know what different investment is the best vehicle for them. So that's a common challenge. They don't know whom to get in touch with, right? They don't know whom to call because if they go to a bank, they will stick them some traditional mutual fund, which is not good for them, or put them into a locked-in GIC where if they take out their money, they're going to be penalized, right? So these are the challenges that they are facing, and I think it is so important. It's so amazing what you're doing today, Andrew, to spread the knowledge, spread awareness
Appreciate that.
amongst everyone out there.
That's great, and you're the guy to talk to because you've built a great business. You're continuing to build your book, and like you said, you came here 7 years ago, so you have done the experience yourself, and you're a knowledgeable guy in the field. So somebody who is new to Canada, that's why we have Harshan. You're the Canadian dream. That's what people are trying to do here. So I love that. Just touching on that. So short term versus long term, because somebody's coming here, they're most likely their goal is to plant their roots in Canada. Just can we talk about maybe some short term investments versus long term? What you normally see?
Sure. Yeah. So short-term investments is something where you want to buy a house in the next 8 months. You want the money for kids' education. You want the money for your wedding. It can be anything, right? So short-term investments is the best avenue for short-term investments. There can be 3 to 4 different avenues depending on what's your risk tolerance or what's the purpose of the money. You can either park it into a savings account. Now again, unlike the banks, I have options from 10 different institutions, and I will give you the account which pays the most amount of interest. You can park it into a GIC, which is Guaranteed Investment Certificate. There are different types, different kinds. There can be 60 days, 90 days, cashable, 1 year, 5 years, all different kinds of GICs. You can put it into a money market mutual fund, which is similar to a savings mutual fund, but the difference is it is not going to be invested into the market. So your money is safe. You might earn an interest on it. If it's a bad market, you might not, but your capital is preserved. So preservation of capital, which is very important for short-term investors. Or you can put into bonds, which gives you interest every 6 months. But that again is a vehicle for someone who's retired or nearing retirement and looking for a consistent income. So these are the different avenues.
I like that. That was a good, concise. I know. Again, and I told you this when you came in.
Yeah.
We're trying to differentiate the podcast from being just a textbook of information,
Right.
and try and keep it watchable.
Right.
You know what I mean? So
Right.
I appreciate. I can hear. Each topic you mentioned. I know you could spend an hour talking about and diving in. So I really appreciate you.
I don't know
keeping it-
the short form answer.
Exactly. No, I know, and I don't blame you because it's not. You don't want to give too little information. We do want to cover it. So, on kind of a trait of what we do here, I always do just some common questions, and I'm going to throw you out just some very, I don't want to call them buzzwords, but common investment vehicles, and I want you to just hit me with the pros and the cons.
Okay.
Okay, so let's start. These are just common investment vehicles. Stocks, pros, cons, go.
Pros is unlimited potential capital gain, capital appreciation. Con can be risk of losing your money.
Fair. Bonds.
Bonds is tax. The pro is you can get benefits from taxes, and the con would be it won't give you a lot of growth potential.
Right. Mutual funds.
Mutual funds, pro is again you get the exposure from 50 to 100 different companies. Con is it's not for short term.
Did I give you GIC already?
You didn't.
Okay, GIC.
GIC, the pro is again preservation of capital. Con is your money's locked in.
Okay. This is more in my neck of the woods, but real estate.
Real estate. Real estate. The pro is again market can go either way, right? And let's hope it goes up.
We're praying. We're praying.
Let's just pray it goes up. Con is no liquidity. Too volatile.
As a real estate investor, I agree with that. Like we saw it down, fired up. Now it's down. We're hoping it goes back up with the rate cuts and hopefully the future rate cuts in 2025. Couldn't agree with you more. There is a lot of volatility and your money is tied into it. So if you have a fixed term, we're paying a break penalty. If you're in a variable, your monthly payment could go up, could go down. A lot of volatility in real estate. Last one, and I got lucky. I wish I put more money into it, but hindsight's 2020. Cryptocurrency.
The pro, I don't know if there's any, but it's too volatile again. So I wouldn't want to say there's any pro buying crypto. There are a lot of investors out there buying crypto, but again, it's something that nobody understands. Just like Apple unveiling or Google unveiling its Willow chips, which nobody knows about. But as soon as it came out, people went crazy and the stock was up by 5% or even 15%, I think. NVIDIA, right? The stock has been up like the money. It has just given 10x return. If you had started with $10,000 10 years back, your portfolio would be worth $4 million. So crypto is something which it's too unpredictable, it's too volatile. I wouldn't recommend.
I like that. I mean, I feel like it's a bit of playing the lottery. Like some people got in, and I did have a couple coin early, and then you saw insurmountable amount of growth. But to me, it's like if something in the news can affect, and I mean it happens in stocks too, but not to the same level. You even, and I'm going to lead into this later in the podcast, but like the Trump presidency, you saw the growth of Bitcoin.
Exactly.
And then there's also new coins coming out all the time. So I have to agree with you. I personally, I'm not an expert. That's why I defer to you. But if somebody's coming to invest, you're not putting their money in Bitcoin or in Ethereum, or you're not recommending that, are you?
Not directly, but being a broker, being an investment broker, I have access to 6,000 funds. I've got access to thousands of different investment vehicles, right? So I have investments which invest into crypto. So I have investments which invest directly into Bitcoin, or there are companies that are investing directly into crypto. So not directly, but indirectly, yes.
Okay, that's interesting. All right. So pros, you're still stuck on no pros on the Bitcoin?
I don't think there's any pro. I mean, there's no pro. There can be exponential growth. Like Bitcoin is right now 104,000, but it can be 20,000 tomorrow. So it's so unpredictable, and you don't know what's going to happen. If you need your money in 10 years, and if your 100,000 is worth, like I have a client who's a client of mine right now. He put 80,000 into crypto. His portfolio is worth $15,000.
Wow.
He wants to just get out of it. And just like you mentioned, there's so many coins out there. So most of the coins are meme coins, like Doge, Department of Government Efficiency.
I'm like, what is going on here? Yeah.
Right? So there's so many meme coins, there's so many joke coins, there's so many, just for the sake of it, so we don't know what's real, what's not. But at this point, if you are a serious investor, or even if you're just an investor who wants to grow your money, crypto is not for you.
So on that topic, because like you fed into my next question too. So when somebody's coming to you, what are strategies that you implore for long-term growth?
So again, it depends on person to person.
So another thing I'd like to touch on, I'm just going to give you two hypothetical scenarios, because there's so many answers for every individual person when they come to you. Different stages of life, different financial literacy, different financial ability, or what they have in savings. So let's just start. I'm going to give you just two generic ones. So somebody is 25 years old, they have 10,000 in savings, they listen to the podcast, they see how well dressed you are, and they go, and knowledgeable, and they go, I'm going to call Harsh. Somebody like that, what do you suggest for them?
So for a 25-year-old, $10,000 in savings, I would suggest we invest it into mutual funds, because that gives you access to a lot of different companies into one single mutual fund. And I can break it down into 2 to 3 mutual funds just so that you get more diversification in your portfolio.
Like that. I like that a lot. Let me think of another one. Next scenario, somebody's 40, early 40s, making about 150,000. Let's say that they're a project manager in construction. They have 2 kids, teenage kids, and they have 200,000 sitting in, kind of, let's divide it between RRSP and just regular traditional savings.
So for someone like that, I would put their money into ETFs and stocks. Just to dive a bit deeper, what I do in my company, we have 2 different types of accounts: traditional brokerage and guided portfolio. Traditional brokerage is basically where you just pay annual account maintenance fees. And guided portfolio is where you pay annual fees to the advisor. So since you're paying an MER on the mutual funds, I would put you into guided portfolio, where you get access to stocks and ETFs, and you pay very low fees because you pay very high fees on mutual funds. But it all depends. If you are someone who's not comfortable with taking risks and you don't want stocks, you don't want ETFs, we can always put you into mutual funds. As Andrew mentioned earlier, there'll be thorough analysis beforehand. I will study your situation, study you, and what you're comfortable with, we can go ahead with that. But to answer your question, stocks and ETFs.
Good. That's a thorough answer. I like that. Okay, let's move into current market sector update. So, and I'm pleased to be joined. Harsh, it could be doing Christmas stuff. We're right around the corner from Christmas, which means we're right around the corner from a new year. So 2025, what do you see in terms of the market? What is your, let's call it, financial forecast for the year coming up?
2025, it's going to be a great year with Trump getting elected. The market is so excited. The market is all green. It went down a bit. I think it was day before yesterday when the Jerome Powell announced there's going to be a 25 basis points rate cut. The market is so sensitive to such news that everybody started selling their stocks left, right, and center. And I think S&P was down by 3%, Dow was down by 2%. But what I see is 2025 is going to be a great year in terms of rate cuts, in terms of the market, in terms of real estate, in terms of investments. It's going to be amazing for investors who are starting out. It's going to be amazing for investors who have had their money already invested.
So everybody, that's the Harsh forecast. I like that. I think that's good. Sector-wise, which sectors do you think pose some of the best investment opportunities for 2025?
So there are 12 different sectors. Just to break it down for the listeners.
Sorry, I don't want to cut you off. I want to highlight, if you have, I wave a magic wand, here's 100,000 of investment money. What sector are you placing it in?
To diversify it, I would say retail, I would say IT, consumer staples, consumer discretionary, a little bit of healthcare.
So those, and which sectors do you think are gonna? Would you predict another harsh forecast for growth? What do you think we're gonna
By
see?
the way, Andrew keeps on saying Harsh. My name means happiness. Just wanted to put out
Yes, I know. I should have introduced it with that. And you will be happy after you talk to him, after you see the portfolio he helps you with. So, any sectors in specific?
any sectors in specific which is going to be doing very good.
And I know you need a crystal ball to answer these. So, and I said this, I think, to our previous guest when we were talking about the future. It was more of a real estate conversation. But nobody's going to watch this back and say, I heard from Harsh and now I put all my money in and it didn't grow the way he said it. Just to prefix the conversation, just your opinion.
My opinion would be again the same. Technology, I wouldn't put all my eggs in one basket. That's something that you would have heard a lot of times. So, obviously, technology is doing really good, but you need diversification in your portfolio. So, I would still go ahead with technology, retail, consumer staples, discretionary, a little bit of healthcare, a little bit of industrial, all of that.
Yeah, no, and that's that kind of feeders into we're going to talk a little bit about more. We're asking for 2025. We're going to talk further. So with the Trump presidency, like I noticed personally on my own investments, everything kind of skyrocketed and took off. How do you see in the new Trump era, the Trump era presidency going forward? Do you see positive growth? What's your take on that?
I mean, with MAGA, with Make America Great Again, Make America Wealthy Again, I think it's going great so far. But with the bipartisan bill, I'm not sure what's going to happen. The government's on a standstill right now. Talking about Canadian economy.
Well, that's what I was going to ask you. Is how do you think it's going to affect Canada?
Okay, so the tariff rates with the BRIC, Brazil, Russia, India, China, BRIC coming into the picture, Trump doesn't want that, so they've increased the tariff duties 200% for Russia and China. If they continue with BRIC, for Canada, it's 25%. Trump announced that it want to have Canada as 51st state, make Trudeau as the governor. I'm not sure if that will happen or not, but that's going to affect Canada a lot with the increased tariff rates. Whatever we are exporting to US, whatever we importing from US, it's going to get expensive, and whom it's going to affect at the end of the day, it's going to affect the end consumers, which is us. So with that being said, I think it's a very unpredictable state in terms of political scenario, if I may, that we are in right now. And with our current government, it's very unpredictable.
No, you're right, 100%. Yeah.
But I think it's going to affect Canada a lot in a lot of different ways. Being US, the most powerful country in the world, being our neighbor, has both its pros and cons.
Agreed, and I mean only time will tell, but there's some, to me it's both sides of the coin. There's some positive aspects of it, and then there's a lot of worrying aspects with how it's going to affect our economy. Somebody once told me Canada is America's hat.
That's right.
So I guess we'll see what truly happens, but. I was happy when he was elected, just from an investment perspective.
Me too.
I logged into. I'm like, holy smokes! It shot up. So hopefully we see continued growth for us at AJP. I hope the real estate market takes off. For my clients, I hope that, and also from the investment perspective, I hope we end. I don't think it was an official recession, but we end the tail end of what we're going through now, especially in the housing market, and we get into a very bright and prosperous 2025. That's what I hope, and I think that's a mutual aspiration.
I think you're right in a way, but if you think of the market right now, we were into stagflation, we are now into disinflation, which means inflation is slowing down a bit, and if this continues, we might even go into inflation, but I don't think that's going to happen with the rate cuts. Again, I do not have a crystal ball, so don't quote me on this.
Right.
But
disclaimer, yeah.
That's right. So, but if you are someone who is a long-term investor, I would suggest just trust the market, because if the market has been down 4 times, it has been up 30 times. I have seen funds going down to 30% in 2022, but it bounced back to 40% in 2023. So trust the process. If the market is down, buy more, put more money into it, because that's a great time to buy. Obviously, buy something which will grow in the future, not into something which your neighbor Rob told you about. Do not go with someone who is not a professional. This is your hard-earned money. Go with a professional. If not me, then someone whom you trust more. But go with a professional.
I disagree with that. I personally recommend Harsh to my clients. So
Thank you.
go with Harsh. And that's why we do business together. Like, you've sent us deals and clients, and we're very grateful as always for the referrals. But I don't want to speak for you, but it's a mutual respect. Like, you know what we do and what we do best, which is why you send clients. And when I have clients who are selling a house, or let's say they're downsizing and they have some extra money, or an inheritance. We had one recently where I just sent you an inheritance. I think it was actually today. I send them to you because it just goes back to what I said earlier in the conversation. Like, if you're not speaking with an expert, you're going to end up taking, and especially in real estate, I think it's more common even than in your industry, where we're in mortgages, fine, but everybody's a real estate agent nowadays. My brother's cousin can help you sell the house. And if you're not dealing with the right people, you end up losing. Like, whether it's you could have got more on the house, you get bad mortgage advice, you get bad investment advice. It is so critical to deal with experts.
That is so true.
I think you agree with that?
100%, if not more. That reminds me of a story. So I had a client when I used to work at my previous employer. That client had 3 different mortgages, one for 8%, another for 12%, another for 20%. She came to me, she was in tears. She's like, Harsh, I'm paying $10,000 a month. I do not have anything to save. I've got 2 kids. I'm working. She was a PSW worker. So I'm working 16, 17 hours a day. My husband is working. It's crazy. So I sent her to my friend Andrew and TJ, and they helped her out so well. She actually got that house just for $40,000 down. It was a townhouse, and it was $1 million worth townhouse, right? And now she's so happy. I met her recently, and she's able to save almost half of her savings. She's going to buy another property, but AJP took care of her in a way that I don't think anybody would have. So it is so important that there has to be some kind of legitimacy, authenticity. Obviously, everybody wants business. Everyone wants to do business and more business. But we have to give them the right advice and steer them the right way.
And
that
not
is
everybody
so
is
important.
deserving of the business, because I can tell you, before you and I met, how many guys I tried out in your space. And I mean, I'm not going to say anybody was outright terrible, but you want, when you're referring a client, and this is mutual, and I do remember that client, and I appreciate the referral because we helped her out immensely, and I appreciate you giving us the praise for it. But it's mutual. Like, when I give you a deal, or a client, I don't want to call it a deal, a client, I know it's in the right hands. And that's so important, because it's also brand reputation. Like, if somebody comes to us, we do the transaction, or maybe the mortgage is down the road, it's not right now, and we send it to you, I want to make sure the clients are in the best hands, and they are with you. So that's where we've done a lot of great work together. We're going to continue to do great work in 2025, but it's just about dealing with the best possible people.
Absolutely.
And that is why we do what we do. We're in this business. Obviously, we're running a business, but we're here to help people and see their financial goals achieved. And that's why we go hand in hand, you and I. So on that note, because we're talking about how great you are, let's give just maybe Harsh's top 3 financial tips. Could be anything. I want your top 3. Somebody who doesn't know, or they're well knowledge, or they have a lot of knowledge in investing. What's your top 3 financial tips?
Top 3 financial tips would be save regularly, stay consistent, do not panic.
I like that. I like that, actually, especially in investing. Cool heads will prevail.
That's
You
right.
have to, like
Keep
you
calm.
said, keep calm and trust the process.
That's right.
Even in real estate, I mean, it's the same thing. People like, the market's down, maybe I should sell. Is it going to go worse? And
Oh my God.
just relax and let's see what happens. Because historically, there's ups and downs in investing, in real estate. If you can hang on, a lot of times after is better than just making a rash decision.
That's right. And I would just like to touch on something you mentioned earlier. When I'm investing for my clients, I would invest the same investments for my own brother or my own sister or even myself. Whatever I'm recommending to my clients, I have those investments in my portfolio.
So those are Harsh's top 3 financial tips. We touched on a lot of those points, but I wanted to just get a brief synopsis of kind of what you think. Now, we're at the tail end of the podcast, but I don't want to leave the listeners missing any information. So I think we touched pretty well upon the major points, the major investment vehicles, what's going on in the market, but have I missed anything? Is there any special points that maybe you wanted to make in this that I didn't touch on?
I think the different types of accounts, right? There's TFSA, RRSP, RESP, which is, I think TFSA is tax-free savings accounts, which is after-tax dollars, so you do not get any tax refunds. RRSP is before-tax dollars, so whatever you put in, you get a refund when you file for taxes. RESP is for your kids' education, so whatever you contribute, you get a certain percentage contributed by the government. There is one account in particular that is so underused. It's called RDSP. It stands for Registered Disability Savings Plan, which is amazing because you put in $1, government puts in 1, 2, or even 3, depending on your what's your household income. You get a $20,000 bond depending on when you're opening one. So make the most of it. If there's someone in your family or in your network who's disabled, make sure you let them know about this account and give me a call. I can help you guys out with that.
So, can you just unpack that a little bit more for me? So, I mean, I've heard of it. I'm just not well versed in it. So, what does it stand for?
It stands for Registered Disability Savings Plan.
And how does it work again? Just very layman's. Even for me, I'm learning now. As you're doing it, I'm learning now. So
That's amazing. You watch and learn, right?
Yeah.
Live and learn. So it stands for Registered Disability Savings Plan. It is for someone who is on disability. ODSP, they are eligible to open this type of account and they get phenomenal contributions from the government.
And the government matches their investment dollar to dollar?
That's right. Even more.
Really?
That's right. If you are someone who is into very low income household, then the government even contributes $2 for every $1, $3 for every $1.
So that's another gem. That's another gem.
It is.
Okay, that hits those points, and I didn't even thank you for the knowledge. I didn't even know about that.
My pleasure.
And that's why, again, we want to try and keep everything in house. So at AJP Mortgage, we have a designated lawyer, designated real estate agent, designated accountant. You're our designated financial advisor. So I think it's pertinent to have the right information, and it's like another reason why you should call Harsh. I didn't even know about that. So I've heard of it. I didn't know the ins and outs of it. So just kind of in closing remarks, that was brilliant that you brought that up. Is there anything else we're missing, or did we cover the main points?
We have covered a lot of it, but there's it's just the tip of the iceberg.
We
right?
could sit here for the whole day going through it all.
Days and days.
That's what I figured. So, like to thank you for coming out. Always a pleasure to see you. Oh, what you guys don't know is this is not just for the podcast. He is always well dressed, like an actor.
Thank you, Andrew.
So thank you again, Harsh. Always a pleasure.
Thank you so much for having me.
My absolute pleasure. And just in closing, remember the name, AJP Mortgage. And if you deal with us and you have investment opportunities, you're going to be speaking with Harsh. And this is why Harsh and I work together. So thank you again for coming out.
Thank you for having me.
Thank you.